So next, we are going to be jumping to the Tepper Cleantech case competition. So Emerson is a sponsor of this Cleantech case competition, and so I wanted to invite Thurston Cromwell up to the stage to share a few remarks about where Emerson Ventures kind of has its position in this space. So thank you, Thurston.
Well, it's a pleasure to be here, and on behalf of Emerson, really do appreciate the opportunity to have the case we put forward for Emerson Ventures as the basis for the case competition. I'm hoping to be of tremendous interest and benefit to us, and I hope all the participants and the people who will see the presentations get a tremendous amount out of it. As to everything Paul was saying, all the trends he put up there and all the things where we're headed in the energy transition are at the core of what we're trying to do at Emerson. If you aren't familiar with Emerson, we're an industrial automation and software company. We've been around since 1890, originally making fans, but we've come a long way. We have 63,000 employees worldwide. We have 130 manufacturing locations. Engineers are at the heart of what Emerson does. And to that, I'd be remiss if I didn't mention here at Carnegie Mellon that we've been named one of the 50 best places to work for female engineers and one of the best places to work overall by Forbes. So our Power and Water Solutions business is actually based here in Pittsburgh, so little plug. But Emerson Ventures, we focus on supporting the strategic technology and innovation objectives of our businesses. So to that end, we look at things of high strategic relevance to our businesses, and in the three pillars in which we invest, discrete automation solutions, industrial software, and environmental sustainability. The environmental sustainability pillar is at the core of today's exercise, and probably the most impactful and an element that we look for in all of our investments. So thank you for the opportunity, and I can't wait to see the cases.
All right, good morning, everyone. So I'm Ian Gray. I'm a second-year MBA student across the street at Tepper, and we're thrilled that you all are here for for TC3 2023. We have 4 finalist teams who will be competing today. The competitors are represented from 4 different schools, and basically the goal of this competition is to inform sustainable investment for the panel of judges, which includes judges from Emerson Ventures and some other organizations that I'll talk about briefly. So I want to give a special thanks to Emerson for sponsoring this competition, and to all of the judges who will be participating today for lending their expertise to all of the teams who will be competing today. So to introduce the judges, and you guys can start to all come up to the front table, we have Professor Chris Telmer. He's a professor of finance over at the Tepper School of Business, and he's also the faculty coordinator for the energy and sustainability track. We have Flor Marion, energy advisor with the city of Pittsburgh. We have Michael, and I'm sorry, I won't butcher your last name, but he's with Sheets. He asked a great question earlier, and he's an innovation manager at Sheets with an incubator there. And then we have Hassan and Thurston from Emerson Ventures. Again, Emerson is the sponsor for this competition, and Christina Boyd as well from Emerson, who is a strategic planner at the Power and Water Division at Emerson. So with that, we're going to kick it off.
Great. So Thank you so much for being here today with us. We are Team Energy X5, and we are here to explain how we tackle the clean tech investment challenge. For today, we have an agenda composed for four different parts. We will start with an introduction. We will pass them following by a business opportunity. Then we will get an advantages and financial analysis. So. First, let's get to start the team. So my name is Julian. I'm from Colombia, South America, and I have 6 years of experience in product management.
Hi, my name is Ali. I'm originally from Kuwait. Prior to business school, I was in private equity and in consulting.
And hi, everyone. I'm Brenda. I'm originally from Mexico. I have 7 years experience in consulting for business development and technology. And we also have 2 other members of our team who couldn't be here today, but Joanne and Igrim, they have a lot of experience in the energy industry and investment banking.
With that said, as you can see, we are a really diverse team from different parts of the world that we combine. We are passionate about energy, and combining all of these, we are looking for giving the best advice to Emerson. So, and which is that advice? We will start with a recommendation. So we believe that you should invest in AMP Control and electric bike company that operates in the electric vehicles industry. They are a software management fleet for these electric vehicles. And this industry actually, based on some reports, is up to grow 19x, which means that this investment can grow until 27x in return of investment. And we will look at those details in the following slides. So how we start, it's by understanding actually which was Emerson vision. We started understanding that Emerson is focused on innovation, safe and sustainable solutions, that they actually have a big footprint with more than 100, operating in more than 100 countries, focused on different industries like oil and gas, chemicals, and that they operate in these 3 different big areas, automation, commercial, and residential, basically focus in these in the first 2. We also look at the annual report and news. We understand that they are in a transaction with Blackstone, and that creates some challenges in terms of like how this transition will follow. But most importantly, we understand their commitment for becoming a net zero gas emission company by 2045. Opening to the numbers, we realized that actually there is a big opportunity in the first area, automation solutions, compared with the other different, among the other areas. We also analyzed the ESG report, seeing the 4 at Emerson to become, to increase their score in the MSCI from a B company to an A company. Then we believe, but this is mainly because of social and governance efforts. So we believe that there is an opportunity to increase actually the clean tech sector, the clean tech. There is a lot of opportunities in the clean tech area. So analyzing their portfolio, we also explore which have been the last investments from Emerson. And we know that they are focusing software automation companies in micromining or utilities with this kind of investment from 9 billions to 18 billions. But how was our process to select this company? So we started thinking about the different 7 focus investment areas like hydrogen, batteries, carbon capture, and we filter with macro economics indicators like CAGR, growth, market, and we filter these to select 4. With those 4, the team brought 3 different companies per each of these big focus areas. And so that sum up around 12 different companies, 12 different startups. So to select the startup, we created this customized framework divided in 3 different parts. The first was a step of 7 different pillars. As you can see, there are things like synergies, product, team, and then 22 different factors that follow into these 7 pillars. We, as you can see there, the biggest ones are the synergies and team. In terms of synergies, we look into direction, not just how this startup can actually how Emerson can contribute to this startup, but also how the startup can contribute to Emerson products. In second place, as you can see there, we have teams. We believe that at this early stage, it's very important to have a robust and a complete team. So we were very resourceful to find different ways to evaluate this team, like, for example, scored in Glassdoor, the experience of the founder, and other ones. So with all of those 22 different evaluation factors, we selected AmpControl, which is a company, again, that operates in the electric vehicles. They are a software fleet management company, and we believe that can be easily integrated in automation and commercial. Then, to evaluate if the company was the right company and the right industry, we use these two different frameworks. And want to highlight in the 5 forces analysis the difficulty for other players to enter in the market. This is actually based on, because you need experience in AI, you need experience that you will see in a moment, but you need experience in electric vehicle fleet management. Also, they are one of the first movers in this industry, becoming like, collecting a lot of data that actually they use for their services. In terms of the PESTEL framework, I want to highlight the political and the environmental. In political, there are a lot of benefits, as the previous speaker actually was mentioning. Biden with the project of 50% of the fleets electric vehicles by 2030, and also environmental impact. This is very important to understand actually how impactful will be this industry in the future. I like this analogy, which is one electric car in the park industry. It can reduce the same amount of contamination produced from a flight from Spain to London. But for explaining about the company, I will pass to my colleague Brenda, who will explain more about AmpControl Magic.
Thank you, Julian. So yeah, let me explain a little bit more about this company. As Julian said, this is a charging management software. It's cloud-based. It was founded in 2018, and their headquarters are in New York. So in a nutshell, it allows users to track, optimize, manage charging operations. And they're currently partnering with main companies in the industry to offer solutions in 4 main segments: fleet operations, charging fleet operations, vehicle manufacturing, and utility companies. So let me explain to you more of how the solution works. It offers optimization tools in 3 different areas. First of all, demand chargers. So the technology detects the demand levels that will optimize your fleet operations, level 1, level 2, and DC charging. It reads peak hours, so when demand is more or less available, and optimizes the charging configuration based on the most cost-effective solution. And then 3, it allows vehicle prioritization tools, so based on your fleet operations, your schedules, and as I said before, your peak hours, it determines which vehicle should be prioritized in your queue. So with all that, it takes information from internal, external sources, schedules, fleeting operations, demand, and uses this process that we call the smart charging process that uses information not just about your client, but also more than 100,000 iterations. So just to demonstrate the potential of this software, on the left you have a real case, success case. They partnered with Revel to create the largest fast charging hub in North America. They managed to decrease power demand by 45%. And so let me just put a hypothetical example. If you were a fleet operator, let's say a rental company, Enterprise is just an example, imagine that you have 30 vehicles under your fleet, and you're trying to optimize your operations as much as possible. These business owners face very important decisions and complex scenarios. So imagine 30 vehicles. Let's say that you have 10 charging stations. Each station has different power levels, level 1, level 2. So the time it takes to charge a vehicle, it varies a lot. So you have to they make decisions based on your demand. If you're a retailer and you don't know exactly at what time would your car be returned, or at what exact time would your client come to pick up the car, you have to make very important dynamic decisions. And this is where this system comes into play, and this is the value of it. So let's talk a little bit about the market opportunity. We base these estimations on the number of fleet that currently exist in the US, a total addressable market of 7 billion and an obtainable market of 7 millions. It's important to say that we estimate the huge potential of growth of 19 times. Based on a study, the current existing charging stations is 1,500, and it's expected to grow 19 times to 29,000. And just to make sure that this company is a good fit for Emerson, we took the time to analyze how the portfolio configuration currently exists in Emerson. So everything that is on the left and is under Emerson is their current configuration based on the 2022 reports. So we understand that there are currently 3 main priorities on their core portfolio: safety and productivity, discrete automation, and process and hybrid automation. Emerson adds value to this core portfolio with 4 adjacencies: industrial software, test and measurement, factory automation, and smart grids. We believe that AMControl complements this current configuration by adding value to the process and hybrid automation. And not only that, we believe it's a good complement because of the core configuration of their solution. As I said before, it's a cloud-based software. It's flexible, so you can utilize it in different Emerson's portfolios: transportation, energy utilities, facility management, and automotives. And it's based on the technology of machine learning as a cloud-based, and it allows your customers to optimize their current operations. Now let's talk about their team. These are the 3 main founders. The current company is composed of 20 employees. Most of them are based on software development. And based on the strategy that you can see in the company, they share a lot of Emerson's values in terms of DEI, in terms of integrity, in terms of innovation. And then let's observe the competitive landscape. We mapped here all the most relevant competitors in the industry. Everything that is on the left, ChargePoint, Enel, Webasto, have very interesting propositions. We believe that these 3 companies are more focused on the hardware aspect of their solutions, so their software configuration is less charged with artificial intelligence. And then we have Greenlots. It's powered by Shell. They offer some of AMControl's existing charging management solutions, but they are very limited on the fact that they're only available for Shell charging stations. And then lastly, 4Pro and EVgo. They offer software capabilities, but they're concentrated, or they're limiting their solutions to level 2 charging. So this is one of the reasons why we feel AMControl offers a wide variety and flexibility to their customers. Now, let me pass it to Ali to talk about the financial projections.
Thank you, Brenda. So for the financial projections, looking at what we used in terms of assumptions for the revenue and the costs. So looking at the revenue projections, we've actually used the number of charging stations as the base assumption. These are in millions. So you see today there's 1.5 million charging stations in the US, mostly are residential. That's going to increase to 27 million by 2030. Overall, the CAGR is 39% across all of them, but we wanted to really point your attention to the fleet depots, which is expected to increase by 51.3%, which is where fleet management would be mainly gaining from. So even if you look at the subsegments of charging stations, fleet management, which is under fleet depots, would have the highest CAGR. In terms of cost projection assumptions, what we used here is we looked at SaaS, the cost structures of SaaS companies as a percentage of revenue. As we estimated, again, these are just estimates, illustrative, but today the cost as a percent of revenue being over 100%. And then next year, if Emerson decides to invest in this company, we expect the cost structure to go up because with the fresh capital, they'd be revamping and adding costs to capture the market growth. And then eventually that number to stabilize down to 72% of revenue. Now, what does that look like in terms of financial projections? As you can see, everything, again, is based off of the number of charging stations. And then the cost structure, as we mentioned, initially is over 100%. But by year 4, that's when the company becomes a positive cash flow, when they manage to get their costs below 100%, actually down to 72%, and then onwards. And then also, one more point, in the initial phases, we actually modeled out the cost structures based on how much revenue SaaS companies are generating. So it's actually the beginning part of this, the first 4 years, is the average of what SaaS companies would at that generating that level of revenue. Now, what does that look like in terms of returns for over the next 5 years? We think it's very attractive. What we've done here is we've took the exit revenue projections, and then we've applied a revenue multiple of 3.4, which is consistent with what SaaS companies of that size, what multiples they're trading at, or if there was any precedent transactions or private transactions, it's at 3.4. That gets us to equity value of, equity value of 640 million. And then we've applied a 17, again, we looked at the pre-money valuation with $4 million going in. It gets us to 17.1 million. We know that Emerson could invest up to 5 million. We thought we'd reserve $1 million in contingencies when they hit milestones, then potentially Emerson could invest further. What's even more attractive here is the 17.1%. We think, like when Julian first explained the universe of companies that we could have potentially invested in, one attractive factor for us was making sure Emerson has a good representation, and 17% we believe is a good strategic ownership percentage, board representation, and in case the business becomes an integral part of the economy, then Emerson could think about it in a different way in the future. And with 17%, that's enough influence to do that. Now, the strategic partnership we believe that the strategic partnership between Emerson and Amp Control could be beneficial to both parties. Looking at the revenue stream, Amp Control will be able to gain, Emerson will be able to gain access to the EV charging stations through software, which is consistent with automation. However, on the other side of it, Amp Control, which is strictly focused on fleet management, the technology and the AI, could potentially be implemented across other Emerson areas. Of course, Emerson, in terms of R&D budget, would probably be much larger than Amp Control, so we see that benefit as well between the two companies. And then in terms of sustainability, they're both in line when it comes to managing energy costs. And then last but not least, it's the diversification factor. So this is us on the way to Pittsburgh. We found a Tesla charging station, and we got really excited. And then we found out that not all cars can charge using the DC fast charging in Tesla, but also Revel, which is a use case for Amp Control, actually is a Tesla fleet. So we just stopped and looked at what Tesla charging station would look at. But thank you very much for listening to our presentation, and we hope you enjoy the rest of the day at this conference. Thank you.
Well, thank you so much, Energy 5X. Now we will open it up to a Q&A. We'll have up to 10 minutes for a little Q&A before we go to the next presentation.
I'll start out. One of the things you noted was how your projections were based on the addressable market that you saw for fleet charging.
Right.
How did you think about their relative competitive position in the market and how they would be able to capture a share of that large market?
So we looked at it from the software side. So we thought, every charging station or every charging station is going to have a need for optimization. And based on that, what would it look like in terms of if you have a commercial fleet, what would you charge per charging station? We assumed $120 a month for a commercial charging station. And then, based on that, we used that number to build it out, the revenue, the potential revenues for AMP Control. But does that answer your question?
Well, I guess my question is more around what indicia of success as to product market fit
yes.
and early stage win rate at this small scale leads you to believe that at greater scale that trajectory will exponentially increase?
So in terms of success, the best metric that we have here, I think, is looking at the market share, like how much would they capture in terms of market share up front. We thought starting with 0.2%, like this is very small, and since they're already in New York City, and since they're already using Revel as a case, they also signed a few partnerships with public school systems that have electric buses. So, like, let's say it's 0.2% of the entire total addressable market. The most we thought it could scale conservatively is 1.2 to 1.6% market share. But that's the success. That's in terms of success rate. Thinking about success rate, that's how we thought about it. We said, like, this is conservative. We're not estimating anything over a 5% market share. So yeah, that's what we have there.
Hello?
Hello.
Hey. So my question is around the customer. Like, who's the core customer you're going to initially try to go after, and describe who they are, describe like what pains they have, like what do they need, and like why is this solution the right thing for them, and any evidence you have around that.
Yeah, of course, great question. So as I mentioned before, they're directed to 4 main business units. Those are the ones that are at the top right. Right now, everything that we have described has been concentrated on fleet operators and charge point operators. These are the ones that have the highest need for this type of energy management software. They currently utilize it for the other 2 segments, but it's a secondary market. So to answer your question directly, and I will go to the example. These are the people, the companies that manage huge amount of fleets or vehicles and are facing like complex decisions on which are the most effective charging levels, optimization times or charging times to make the most optimal decisions and best of charging times. Does that answer your question?
Could you talk a little bit about the competitive risks here? This is a software business that's driven in large part by data. Are there some processes or are there some things inherent in this business that represent protection from competitors copying, coming up with alternative data sets and so on?
Do you know more about that?
For sure. I will take this question. Thank you. I will say that first, we have actually explored the different companies in the market. We found that this one is one of the only players that is using AI and machine learning, which is a very tough technology to learn how to do it. Basically, with the examples that they have started in New York with Revel and other fleets, they have collected information. And to actually train these machine learnings, you need this information, thousands of data, thousands of cases. This company actually is one of the pioneers of using all of that information to prevent any case or weird scenarios that can happen in fleets. So That's for one side. So in the first place, they have actually the expertise, and the second place is that they have the data. So those two things are very complicated, as we mentioned, for other company to enter in this market or replicate what they are doing. The team also, all of them has a master's in computer science. They have experience working with fleets. So we believe that also that give a lot of advantage to this team. I don't know if that answered the question. Yep. Okay.
I got another follow-up question to that.
For sure.
Did you get a chance to talk to the folks at, what was it, AMP Control?
Yeah.
So we reached out to the company under this short time frame, and unfortunately they haven't gone back to us yet. But we spoke with Explorer Capital, which is one of the seed investors. They actually invested 1.1 million in the company as a seed. They have a very strong conviction behind the team. Explorer Capital is one of the ex-Yahoo guys, early on founders, and their startup is very focused on not just finding technology, but trying to find things with AI and machine learning overlay. So that's the that's who we were able to talk to and hear from them.
I have a question. What would you say the number one synergy is with this company for Emerson with respect to our portfolio? And that could be the company, but also the entire EV industry, because we don't really have a strong play in that right now. We have really strong plays in the power industry, which will potentially feel an impact in generation demands from EVs. But did you think about, what is the number one synergy for our portfolio with this?
Yeah, so first we looked at it from a software perspective. Like, there's a lot of players in the market that do hardware, and we thought, I don't think Emerson wants to go out and build charging stations. So we thought more, okay, let's step back. What segment is Emerson could find the most synergies in automation? And we saw, as you've mentioned, power is a huge emphasis. So we thought, we imagined a scenario where Emerson has the capability of talking to the largest fleets of electric vehicle companies across the United States and be able to negotiate or help them with a tool like this. And of course, AMP Control is a startup, small company, so we thought with Emerson's influence that could be complementary between the two. But if we look at we looked at the report, the Q4 22 report, and within the automation business, we saw that there is an emphasis on, for example, measurement and performance within the automation segment itself. We thought that this company is doing measurement and performance, that's one of the things. We thought also, we looked at, for example, so there was that, and then there was the, so in terms of the sustainability report, where Emerson is trying to go with the type of businesses that might be attractive to the portfolio, and that's how we sort of, we thought a lot about the hardware component and the development and what potentially Emerson wants to get into or what they don't want to get into, because for this type of business, it's important. But yeah, so the focus on software, we thought, was one of the main reasons why Emerson would find this attractive.
Thanks.
Thank you.
Okay, I think we have time for one more question, if there is one.
Yeah.
The founding team felt like it was a lot of technical people, saw a lot of engineering words up there. Do you feel like there's a biz dev skill set on the team, and did you feel comfortable with that?
So there is, So there's six business development people on the team out of 20. We do think that's very important, especially to go out and build partnerships with, for example, Revel. That's it. By the way, Revel is 200 fleet ride-hailing service in New York City. So we thought that business development would absolutely be critical to go out and build out these partnerships. But what's even making us more enthusiastic is like thinking about it on an Emerson scale. You know, like 200 cars fleet is not really, you know, but on Emerson, which is a national, like having that national scale, we think that you could potentially go and talk to conglomerates that have tens of thousands of supply chain, transportation vehicles, and all of that. Yeah. Sure.
Just to make sure I got this from the presentation, could you just tell me what exactly is missing in the market at this point in time that this company is going to sort of fill that hole?
So I believe it's the combination of the value proposition that this company gives. So for example, the AI component of like you input, for example, my colleague Brenda gave an example of 30 vehicles into a system, and having the system automatically configure and learn based on your usage. We thought that that specifically was missing from all the other ones. All of the other ones had beautiful visuals in terms of like, oh, this is where your car is going, where your car needs to go, but none of it gives guidance as to how you should do it, and furthermore, like the optimization and learning, we thought would be very important, especially, especially for commercial, where the timing and in terms of costs, that could be super sensitive.
Thank you.
Yeah.
Well, thank you very much, Energy 5X, and thank you, judges, for the thoughtful questions. We'll just take a minute or two and get set up for the next presentation.
Thank you very much.
Hey everyone, we are the Sustainability Scalers, and I first want to introduce everyone. My name is Hutan Bazargadad. This is Bhavana Paratila, and this is Stefan Ekman. We have two other teammates who could not show up today, Min Win and Harshita Tupili. So I want to give some background to our investment selection methodology and our process. So we first wanted to find VC firms that had a similar portfolio or similar strategy as you do, to then find which of their portfolio companies to dig into. So we decided to select 3 VC firms, and from there we wanted to scan all their portfolio companies that would fit the funding criteria and the overall philosophy. So from there we scanned about 70 different companies. From there we decided to do due diligence on 14 companies specifically, and we had a criteria that focused on industry and market parameters, company parameters, financial and investment parameters, as well as portfolio considerations. And from there, we decided to focus on one particular company to do extensive due diligence on and pitch today. Stefan will now introduce the company.
Yep. So after following this methodology, we ended up selecting Electric Fish. Electric Fish is a electric vehicle charging infrastructure company. But unlike your typical EV charger, these are battery integrated. So they have very unique characteristics that differentiate it from its competitors. They can be deployed very quickly. They're containerized. So they don't require the trenching and grid infrastructure upgrades that fast DC chargers like EVgo's require. And this bidirectional battery energy storage system is patented. And these can also deliver reserve capacity and frequency response, different services that the grid requires under a high renewable energy portfolio for many of these utilities. And these are primarily focusing in California for the time being, focusing on gas stations, independently owned gas stations, but eventually hoping to expand to different types of sites, and they have their proprietary siting algorithm, which helps them determine what the high potential locations are based on prevalence of EV vehicles and the need for some of these grid services. Now I'll talk about the strategic fit with Emerson and Emerson Ventures. So, Emerson being a leader in software and optimization for the power and transmission sector, we see many synergies. This is a hardware company, but they also include their own patented battery energy management system. Having that expertise in storage and renewable asset management you have Emerson has their own battery system management, as well as their Ovation Green Renewable Energy Asset Management. And Emerson Ventures has made investments such as Virtual Peaker, which manages distributed energy resources such as battery storage. And this type of software could help optimize the use of a product like this in markets like California, where frequency response and reserve capacity are needed. And Virtual Peaker actually works with utilities in California, like Sacramento Utility District, which again, would help with those relationships in California. And lastly, Electric Fish also presents an early stage seed investment. It's under $3 million invested to date in a market that's rapidly growing.
Next, we'll look at their team and employees. So Electric Fish was founded in 2019, and they have 4 employees to make up their diverse team of battery researchers, hardware engineers, energy scientists, and serial entrepreneurs. And we also got the chance to talk to Vince, their COO, and he mentioned they are looking to hire a product manager and an optimization engineer. Looking at their funding history, they had 3 investors so far, which includes Google for Startups and Techstars. And they completed 2 seed rounds in 2021, and their latest deal was a grant of $220K, and they are open for seed funding. Looking at their technology, their main product is 350 Squared, which is a plug-and-play energy storage system for EV charging with a bidirectional electricity meter and an ultra-fast charging port that can deliver charging rates as fast as 100 miles of range in 5 minutes. They also have a data tool called CoreScore, which is a siting algorithm that helps them pick impactful locations. And finally, an optimization engine, which are the load balancing smart chargers. And we do want to call out they have patents for both 350 Squared and CoreScore. We did analysis of the EV charging industry using the Porter's 5 forces plus 1 model. And looking at the threat of new entrants, we rated it as a medium because it requires a high capital investment to enter the industry, but there are a lot of government incentives to do so. But the bargaining power of buyers is low because the access to efficient charging stations remains low. According to McKinsey's EV consumer survey, EV customers rank not having enough access to efficient charging stations as the 3rd most serious barrier to EV purchase. Looking at the threat of substitutes such as gas is medium, since the number of EV owners may still remain low in the upcoming years, and there are still EV purchase barriers such as price and range. Rivalry among existing competitors is high because Tesla, Charging Point, Blink Charging, EVgo, and SEMA Connect are current top companies in the market. And looking at the bargaining power of suppliers for raw materials and complements such as adapters is also low. Overall, EV charging is an attractive industry since the size of the U.S. market for electric car charging was estimated at $25.64 billion in 2022 and is anticipated to increase at a compounded annual growth rate of 36.9% from 2022 to 2030. Looking at viability, despite the fact that more companies are entering the market for EV charging and competing with Electric Fish, there is a clear road to commercialization. 350 Square provides a competitive advantage since their product has a 350 kilowatt charging speed, while the current market leader has a charging speed of 250 kilowatts. They have an additional advantage of having patents for both of their products, which is CoreScore and 350 Squared. Electric Fish is working with existing commercial sites, so installation is more cost effective and timely compared to installing traditional charging stations. And their tool, CoreScore, provides the technology needed for their location planning. Greater market competition may result in lower charging costs and pricing, but installation costs and land use fees may rise as infrastructure is developed. The unique technology Electric Fish has an advantage because it reduces the installation and land use costs, increases utilization, reliability, and enables grid services and demand response.
And now I'll talk a little bit about the competitor landscape. So we did have the chance to speak with the Chief Operating Officer, Vince Wong, who seemed to clearly understand the competitive landscape and how they differentiate themselves. There are other battery integrated chargers out there, FreeWire and Aztec, but they, one, are smaller capacity. So I think the largest is 160 kilowatts. So they don't offer as much in terms of resiliency value and the ability to dispatch to the grid. They aren't as easily deployed. So, Electric Fish has their containerized model, which can be deployed, moved very quickly. And then on the DC interconnection, the fast chargers, those require some of those grid upgrades, trenching that Electric Fish wouldn't need, although they do have the higher speeds. And then lastly, the other form of competitor are the backup generators, which can be rapidly deployed, but they have limited use cases and utilization, wouldn't offer some of the grid services that Electric Fish offers. And now I'll shift to competitor exits.
So this is a list of similar companies and their exit strategies. So looking at each of the technology that they offer, either they're focused on EV charging or some type of grid support activities. Looking specifically at Beam Global and EVgo, they went the post-IPO equity route, and they have a share price of $14.72, while EVgo has a share price of $5.65. The rest of the companies on this list had the exit of merger and acquisition, majority of them being within an operating subsidiary with the parent company. So that would include Dosan Grid Tech, EV Connect, Rhombus Energy Solutions. And our recommended exit strategy for Electric Fish is to partner with BP Pulse, or they can partner with other traditional gas or oil companies that want to diversify their portfolio and offerings.
So now I'll talk a little bit about the pros and cons of the company at a higher level. I think the biggest pro is that they have a patent storage solution, and it allows for speedy and easy deployment compared to the trenching that their competitors have, because all they have to do is plug it into an existing electrical connection and infrastructure. The company has a wide range of portfolio products, which I think is very compelling, including the core score, the siting algorithm, and whatnot. From a leadership perspective, we believe they have a strong industry knowledge and experience, specifically with the CEO, as Stefan mentioned. When talking to him, he clearly understood the competitors. He has an MBA background. He also founded a company as well, so he has experience working in startup environments and figure out how to, he learned how to grow these type of companies. Additionally, there's opportunities to partner with DER aggregators, which would align with Emerson's recent investments in virtual peaker. Some challenges that they need to overcome, but hopefully we believe that with a VC partnership, expertise, and funding, they can help alleviate. So one of the biggest ones would be deployment challenges with mass orders. So with hardware companies, how do we effectively scale both the deployment as well as the relatively high cost of production? I think with hardware, that is a big challenge, but I think with funding, they would ideally want to outsource their manufacturing process, which would both lower the cost, but also help potentially make the deployment easier. And then another opportunity would be, as a VC firm, to help them find the right sales professional, sales leadership to help them launch their product effectively, because we do believe that is a gap in their leadership. So now I'll be talking about revenue forecast to exit, which includes market sizing, revenue forecast, and exit valuation after 5 years. And this would be 3 years before the fund life, because from our understanding, the fund started in 2021 with $100 million. So we wanted to provide at least some leeway to ensure that you get the proceeds, or in case you need to be invested in the company for a longer period of time than for 5 years. So to provide some context on the market, we believe the total addressable market is all gas stations, because that is their business model. But specifically, they want to focus in California. So that is the serviceable addressable market, where we've done industry research on historical data for the past 9 years on both California and United States gas stations. And then our serviceable attainable market would be specifically a combination of, they need to fit the criteria of being individually owned and also unaffiliated gas stations. So nothing like with Chevron or Shell, just an unbranded name. So based on all those parameters, we have reduced the market size to what we think is realistic, obtainable market. From there, we decided that the market penetration rate will steadily increase over time, and we believe that with extra funding, they'll be able to improve their operations, lower their sales cycle, and be able to scale effectively. And hopefully, throughout that as well, they'll have increased brand awareness, which will help the company expand. So one other thing you can note is the systems per gas station is also increasing throughout time in the forecast. The two main assumptions are that with increased funding, they will be able to improve the technology to reduce the size of the units, so then they can have more units per station. Additionally, if current customers in the beginning years like the product, they will then continue to purchase more systems over time. From the price per system, what we focused on was the cost of the installation of the Powerwall, as well as the Powerwall and the unit in general, and then also to ensure a profit margin that will allow them to capture a large revenue. Through our forecasted projections, we expect to get have $20 million in revenue roughly by 2028, and with a revenue multiple of 5, based on competitors that are currently in the market, we believe that the exit valuation will be about $100 million. So with that in mind, we also did some scenario planning as well. So the conservative case, one of the biggest things we'd have to watch for is if there's delayed safety clearance. They are currently working on that when we talk to the COO, and it does seem promising that they'll be able to get that relatively soon, but if not, that would be a big barrier. From another standpoint, another challenge could be users want to stick with brand name chargers and they don't want to go to gas stations and charge their EVs. And then a specific challenge would be if they're only focusing in city areas, they may be missing the larger areas that are not that are rural or in other regions like that. So I think that's a challenge. And then from the optimistic perspective, I think they could potentially work with branded gas stations, but that's not currently in their business model. And then if a higher satisfaction with smaller units can lead to increased revenue projections, that'd be great, I think, for them. And additionally, the category that we mentioned, about 37%, I think would help increase the overall market size, which would eventually lead to ability for them to capture more market share. And then the last option for the optimistic case is that they've made partnerships with California and Michigan to launch their product and to have extra funding. So if those go well, then they'll be able to expand as well into Michigan too. So I think that is another area or avenue for them to kind of reach a higher end than our base case.
So after going through the financials, we also wanted to talk about the sustainability impact of this investment, represented by the 25% equity stake in Electric Fish. So we got in touch with Electric Fish, and they provided 2 metrics that they've used in the past. One is the emissions reductions in CO2 that comes from the ability to dispatch the bidirectional battery chargers to match the load instead of using fossil fuel generation. They had provided a range between 60 kilograms and 320 kilograms of CO2 emissions per megawatt hour of fossil fuel generation. And then the second metric was the air pollution reduction. By reducing the life cycle carbon intensity of EVs by up to 40% by reducing the dirtiness of the charging electricity. And we used the conservative end of that, which was 80 pounds of nitrogen oxide per gigawatt hour. So we took the average discharge capacity of 252 kilowatts from this battery. The average utilization of public EV chargers is about 2.5 hours or 10%, based on NREL estimates. And then on the grid utilization piece, discharging back into the grid, we took a conservative approach and said that was a 5% of the daily usage would be used for the grid at 1.25 hours. So that's how we came up with the yearly grid and EV discharge energy that replaces the equivalent energy that would have come from fossil fuel generation. So from there, we forecasted the equivalent CO2 and nitrogen oxide reductions based on number of chargers. And we determined that Emerson's contribution, what Emerson's contribution would be as a 25% equity holder, which is the bottom right amounts.
So now, as a consultant, we would also want to propose a potential valuation and term structure that could be beneficial for your firm. So at this time, we would recommend potentially doing a $2 million investment in the Electric Fish Company with a $1 million syndicate. The reason why we recommend a syndicate investor is because with hardware companies, they typically would need more funding to make sure they can deploy their product, and as well, this could mitigate portfolio risk as well. We would want to have 25% of, not we, I mean Emerson would want about 25% ownership in the company, and this would allow for the possibility of investing $3 million more in future rounds as well. And then with the 99 or roughly $100 million exit valuation, we would expect that the proceeds that Emerson would receive at the end of 5 years would be about $25 million, with a multiple on invested capital to be about 12x. And the $25 million would represent about 25% of the $100 million fund that they raised in 2021. So, yep. And then the last thing we wanted to discuss was just a term sheet. Most of the conditions that we provided here are pretty standard, but we wanted to cover some of the milestones. The first one is that we want to ensure that they engage with ULs during Electric Fish's planning and design phase within 1 month to ensure that they are moving forward with that safety certification process. And that leads to the second one, that there's an expectation that they get that certification within at least 3 months. We would even consider making that a closing condition to ensure that the product has that proper certification. And then lastly, as a clean tech company, we would want them to be able to demonstrate its sourcing, sourcing charging energy is from a clean energy source. And additionally, another key term that we wanted to call out too is the 3-year vesting, 3-year founder vesting, stock vesting, just to ensure the commitment of the founder to the company. Thank you for your time.
Well, thank you very much, Sustainability Scalers. We now have time for some questions.
So I know you had a little time to prepare for that, but can you explain a little bit more about how do they charge? If you don't do trenches, how do you recharge the batteries?
So they can connect directly to an existing connection. Yeah, I don't know the very specifics, but I know because they're just charging the battery. They don't have to charge directly from the. They don't have to dig underground and also apply for a certain permit where they would require that. It's a longer timeline, 6 to 9 months for interconnection. Mm-hmm.
And just extra context too, I think one of the advantages of that as well is that gas stations tend to have issues with oil leaks underground. So being able to not have to do trenching is, I think, a competitive advantage for this company in this specific market. So, yeah.
2 questions. What is their differentiated competitive technology advantage? They're from the Tesla battery walls and everything else. What about this technology from a sustainable competitive advantage perspective means that they won't be displaced? Question number 1. And then question number 2, making early stage investments at the seed level in a hardware company is going to require considerable follow-on investment. You know, I think you said their last round was only $220,000. How are they mapping out the build-out of a hardware company, and how should we think about the exponential growth of this company vis-a-vis what its working capital requirements would be?
Can I answer number 2? You want to answer the second one? Sure. Yeah, I'll take the first question on the patented technologies. I think FreeWire has proposed something similar, but they do have the bidirectional battery that can be used to both charge the vehicles and it can also be used to discharge onto the grid. and provide some of those services. So I think going back, the patent has very specific capabilities that allow it to respond quickly for things like frequency response and smaller duration events on the transmission system, and they purposefully patented it to handle those kinds of needs of the grid. I'm not sure, there could be other batteries that do something similar, but I think it's having the EV piece as well as that component.
And with regards to your second question, I would say I totally agree that these are concerns, and I think that is the challenge with hardware companies. And we believe, as a philosophy, we wanted to invest in hardware because we thought it was less imitable, that's a tough word to say. But basically, we thought it was harder to copy than the competitors. But as a result, we need to be strategic in the partnerships that we have in the following rounds, or Electric Fish does, to ensure that they can find the right manufacturing firms and processes to help outsource them, because we currently believe at this time they are doing it in-house, the production, but to scale manufacturing and these costs, they need to have a larger team or work with a firm that will enable them to produce more units.
First is I was thinking about the uniqueness of it. It seems like it's just really easy to put somewhere. You don't have to dig in the ground as much. Like, is there a unique use case for that goes outside of the stereotypical, put them at gas stations, Shine Eagle, whatever, that, there's a lot of people exploring charging points. Is there a unique place you could utilize this and a unique need that's currently unmet?
So I think in talking with the COO, he is kind of thinking bigger picture, and they had started thinking about the gas station locations, but I think the need, especially in a market like California where you have such a large penetration of renewables, they're looking at different types of locations and different use cases for that battery storage. So I think that's something that they're working on is how to capture that market, but also looking at the net energy metering law in California. So NEM 3.0 just came out, kind of determining how the battery storage resources are used for distributed energy resources. So I think they are trying to expand the use cases so that it could be expanded to more than just gas stations and typical customer use, but they're also looking at things like fleets, like municipal vehicle fleets, public transportation, that sort of thing.
And just to add on, from an investment philosophy perspective, we solely wanted to focus on just this specific market because we're really focusing on making sure Emerson receives proceeds within the 5-year timeline, because we do believe that there are other markets that this technology can be used for, as Stefan mentioned, but we just wanted to keep it very narrow and a more conservative approach just to make sure we ensure your return.
Got a question.
There's a second question with revenue. Can you clarify how the revenues come in, and just some background? Like, I work at Sheets, and a charge point could be like $150,000, and someone buys $9 of electricity, and you make $1. So, knowing that math and where money comes from, and obviously it needs to be subsidized, where is the revenue coming? Like, who pays for this, and how much are they going to pay for it?
That's a great question. So the business model that we have at the base level is just to sell the product for a 1-year basis, and then if it's a loan, that's their current strategy, I believe. And to pay for the cost of the electricity, I believe the current way we have it set up is the gas stations themselves will have to pay for it, because the revenue that they generate through their charging, they should hopefully be able to pay it back and cover those fees.
Challenge with physical infrastructure is the ongoing maintenance. I don't really see a lot of that cost being discussed in your presentation. Can you talk to me a little bit about that?
Yeah, that's a great question. I think there are two factors. One, since they want to loan this on a yearly basis, the idea would be they would be able to, if they want to renew the product year over year, there should be a condition to make sure there are the relevant maintenance fix-ups and whatnot. And from a forecast perspective, we did not account for that specific cost. We wanted to predominantly focus on revenues because we thought it was we didn't have enough data to necessarily provide an accurate cost forecast, and we thought revenue was a more representative way to estimate the value of the company.
And I guess one aspect on the revenue is that we took the conservative approach, but ideally you'll also have a contract, a capacity contract with utilities to provide some of that reserve capacity. And there could also look at a pay-per-use type model. So they're buying the energy from the utility, but they're selling at a premium at their chargers.
Regarding the bidirectional aspect of the battery that's in this thing, what fraction of the value add here, or the value proposition, is coming from ancillary services to the grid? And what happens if that market just gets saturated with all the changes on the grid? Where's this company going to pivot to if that revenue stream doesn't work out?
So I think what Hootan was talking about was just selling the equipment for EVs and regular charge use. I think that's one big component of it. If you don't have access to the revenues coming from utilities on the grid reserves piece. So I think having that hardware component that you're still generating revenues is a good also.
And just one last quick one. Could you just give us a sharp summary of what the missing market or the value add is here? Patent, speed and capacity of this thing relative to the competition, agility, you can move them around. Can you just sort of summarize in a nutshell what the value proposition is?
You got it.
Yeah, so I think just to summarize, so easily deployable. It's containerized and it can be moved if it's not an optimal location. It's bidirectional charger, so it can both provide reserves to the grid and services to the grid, but also charge vehicles in optimized locations where there's high levels of EV vehicles. And I think those are the two main.
And it is a patent technology.
Patent technology.
Yeah.
Okay, we have time for one more question.
I'm just thinking about the go-to-market strategy. Can you share a little bit about their go-to-market strategy and how Emerson could support that a little bit more, or what the synergies would be?
Yeah, their go-to-market strategy, when we talked to them, we wanted to do more due diligence on that, because that was the criteria that we couldn't find via the website and just our general research. From our understanding, they want to have partnerships in the future with government, with California and Michigan. That's one play that they've been making, but from the go-to-market, from the B2C, the retailers of gas stations, I believe they are currently making partnerships in LA. That's where they're based, and they want to do, they're trying to do some digital marketing and marketing campaigns to kind of make outreach to that and then make connections through that. That's our understanding so far, but as a VC firm, we would help to provide a stronger, longer plan other than what they're currently focused on, because I think at this time, they are more focused on developing and scaling and handling the manufacturing costs. So I think that is an improvement opportunity.
Well, thank you, Sustainability Scalers. We'll get set up here in a minute or two. Let's give one more round of applause for this team.
It's a pleasure to be here and present Polios Bio. Polios Bio is a startup, synthetic biology startup that has a sustainability mission, and they are turning food waste into high-value chemicals. So I guess Polios Bio has the right team to successfully develop and commercialize their technology. My name is Amin. I am the technical lead of the company. I have 12 years of experience in chemical engineering, synthetic biology, and software development. I received my PhD and postdoc in synthetic biology with two of the founding fathers of synthetic biology, Professor Howard Salis at Penn State and Professor Chris Voigt at MIT. And I have designed several design tools that has transformed synthetic biology and are currently being used in academia and industry around the world. My business partner is Makari. He has 5 years of experience in finance and operation and business strategy, 2 years of experience in climate tech VCs and startups, has a bachelor's in environment, economics, and politics from Claremont Mackey College, and currently a second-year MBA student at Harvard Business School. So food waste is a massive global problem. Every year, we generate about 250 million tons of food just in the United States, but 40% of that goes to waste, and from that, 30% directly goes to landfill, which is about 30 million tons of food. And that food waste costs U.S. economy around $400 billion, and also contributes to 5% of the U.S. greenhouse gas emissions. And that's, half of that is from the CO2 emission from the production of the food, and the other half is coming from the CO2 emission from the landfills in the form of methane release through the food decomposition. So food waste in general is very heterogeneous, and insects provide a very low maintenance and cheap way to digest and homogenize them. And because of that capability of the food insects, recently a couple of startups, they have raised about $1 billion of VC money in order to develop and de-risk that technology. However, the problem with their technology is that their main product is just protein, fertilizers, or animal feed, which are low-value products, and that actually makes their business model quite hard. And that also hampers their scalability efforts, and they cannot make a very meaningful impact in solving the food waste problem. And that's where Polios Bio come into the play, and that's how they wanted to change the game. They wanted to pair the insects processing of food waste with the precision fermentation in order to convert the food waste into high-value chemicals. In this case, we are targeting sugar polymers. In their process, they first feed the food waste into insects, which then they would crush them, dry them, and prepare an insect-based growth media that they can feed it to their engineered microbes. And those microbes, they convert them to sugar polymers. There are two main advantages for Polios Bio that differentiates them from the rest of the industry. The first one is that they use synthetic biology in order to engineer these patent-protected microbes to convert them to sugar polymers with much higher yield. And the reason that they need to use synthetic biology is that naturally these microbes, they do not grow on insect-based media. So we need heavily engineered efforts in order to make microbes capable of growing on the insect-based media. The other key advantage is that they are using extremely low-value raw material, which is the food waste, and converting it to extremely high-value product, in this case, sugar polymers. Therefore, they are developing a highly profitable business. Polios Bio plans to vertically integrate along the sugar polymer value chain, all the way from the raw material, the food waste, and down to the final products. And they want to do that in order to maximize their profit and also sustainability impact. They wanted to have the full control over the quality of the final products by doing their own fermentation and purification. And they also wanted to make sure that their entire process is very sustainable. And they wanted to make sure that the insects are coming from the food waste and not from other type of organic resources. So what are those sugar polymers? They represent about $100 billion industry. There are so many different types of sugar polymers in the market with so many different applications, from pulp and paper to textiles to cosmetic industry, oil and gas, water filtration, processed food. But one thing that they all have in common is that they all use very old and outdated technologies that are unsustainable, expensive, and they have a lot of environmental impact. Polios Bio decided to focus on hyaluronic acid, or HA, as their beachhead market, just because it has a huge market, about $15 billion market size, and also it has enough market volume, 10,000 tons per year, that they can capture a small fraction of that. And the price range is also quite high. It ranges from $500 to $2,000 per kilogram, depending on the purity and the molecular weight of the polymer. And that polymer is used as a moisturizer and fillers and gelling agent in a lot of cosmetic and skincare products. So they did their customer discovery in order to understand the market landscape and understand the need and pain points of the customers. And three main pain points emerged from their customer interviews. The first one is obviously the cost. HA is quite expensive, and customers would love to have a cheaper alternative. Second one is sustainability, and Polyus Bio is targeting cosmetic industry, and right now sustainability is a major drive in cosmetic industry. And the last one is the supply chain security. Right now, most of the HA comes from overseas, mainly Chinese producers. So these customers, they appreciate alternative resource that comes from the US. Polyus Bio plans to go to market in a phased partnership approach. Initially, they target point source food waste generators like agricultural farms or breweries that they have a sort of more homogenized food waste. So that makes their engineering much easier. And they also plan to sell their product to boutiques or cosmetic brands. And once they have enough market traction, they can go to a much larger food waste generators like the municipalities or restaurants or even landfills. And at that point, they have to produce a lot of different sugar polymers, and then they can go to the distributors for distribution. So their techno-economic analysis showed that they can produce hyaluronic acid at about $400 per kilogram, and that compares with the $800 to $1,100 per kilogram that the current producers are producing. And if they are selling their product by around $1,000 per kilogram, they can get to 60% gross margin. So taking that cost into account, they developed a 7-year business plan to reach to $1 billion in revenue by 2030. And in order to reach that level, they need to produce about 1,000 tons of HA by 2030. So in their plan, the first 3 to 4 years, they will focus on de-risking experiments, R&D, and piloting. And at that point, they are cash negative. But by 2027, they break even, and after that, they can aggressively ramp up their production to become cash positive, and they will reach to the $1 billion by 2030. And by 2030, they need to produce about 1,000 tons of hyaluronic acid or HA, which in order to produce that amount, they need about 10 industrial scale bioreactors and more than 12,000 insects pre-processing boxes. So these numbers may sound a lot, but they actually can fit into a facility that is with a size smaller than a football stadium. So that $1 billion translates to $600 million gross profit. So if they wanted to produce 1,000 tons of HA, they need to process 0.6 million tons of food waste. And that is equivalent of the food waste that is generated by a city of 2 to 4 million people. So their cost breakdown showed that the cost for collecting food waste or transportation, as well as the insects processing and fermentation, is not comparable with the actual or with their major cost, which is recovery and purification. So that also gives them enough confidence that they can, so the insects pre-processing is not a major bottleneck for them. So obviously the economics is not the main factor for their technology development. They also wanted to become very sustainable and environmentally impactful. So currently there are 2 different ways that these sugar polymers are produced in the industry. The first one is the traditional one that these sugar polymers are extracted from natural resources, for example, the animal tissue or plant biomass. In the case of hyaluronic acid, it used to be extracted from the comb of the rooster. But more recently, these fermentation technologies have developed to produce these sugar polymers from native producers. So these fermentation processes are almost the same as what Polyus Bio is planning to do. But the difference is that the current producers are using native producers. And these native producers, they have low yields, and also very often they are pathogenic. In the case of hyaluronic acid, they use a streptococcus, which is a pathogen for humans. Also, I guess the most importantly, the current producers are using glucose and amino acids as a virgin ingredients for their fermentation. And these materials or these raw materials are quite expensive. And they also have a lot of embodied CO2 emission in order to produce their own raw material. So Polios Bio calculated their impact and in terms of CO2 emission. So for every 1 ton of sugar polymer that they're producing, they can actually save 7,000 tons of CO2 from emission. And that comes from saving 5,000 from diverting food waste from the landfill into their production facilities, and also 1,700 tons of CO2 by displacing the current production technology into their own fermentation. So considering their 2030 goal of producing 1,000 tons of HA, they can save 7 million tons of CO2 from emission by 2030. Obviously, they don't want to stop there, and they have the ambitious goal of saving 0.5 gigatons of CO2 by 2050. And to do that, they have to produce around 70,000 tons of sugar polymers and also processing 45 million tons of food waste. So in order to process produce 70,000 tons of sugar polymer, obviously, hyaluronic acid market cannot support that amount of that volume of sugar polymer, and they have to move to new types of sugar polymers, and they are they will focus on bacterial cellulose, alginate, chitosan, inulin, and so on. And most importantly, all the knowledge that they have learned through the R&D and development of HA can easily be applied to other sugar polymers, because these sugar polymers have the same biochemistry and bioengineering. And I guess the important point about the Polios Bio is that it's a platform company, not just a product company. And the same knowledge can be applied to different sugar polymer portfolios. Similarly, for the food waste processing, 45 million tons of food waste cannot be supported by the US alone, so they have to move to new geographies. So they're planning to move to outside the US, to Canada, Latin America, Europe, Africa, India, where there are massive food waste generated every year. They are planning to take about 10% of the global food waste in order to reach their goal. And that includes 15% of the total food waste in the US to be recycled. And they're planning to do that by building a network of about 75 facilities around the world. And that includes about 25 facilities in the US alone. That may sound a lot, but if you compare that with the 600 landfill facilities that currently process the same amount of food waste, that number is not a lot. Polios Bio has been supported by many of the key players in the Boston Tough Tech startup ecosystem. They started their venture last year, where I actually finished my postdoc at MIT. And they participated at the Engine's Blueprint program. Engine is the MIT accelerator. And they did their customer discovery through NSF I-Core program. And currently they are part of Nucleate entrepreneurship program, where I met Makari, and Makari joined the team. And Nucleate is an entrepreneurship program that applies biotech solutions to climate problems. Polios Bio has both short-term and long-term fundraising goals. Right now, they are targeting $100,000 to $300,000 non-dilutive funds through competitions and fellowships in order to de-risk their experiments. And once they prove their concept, they plan to raise $1.5 million of pre-seed to move to the pilot scale. And by end of 2024, they plan to raise $5 million to move into industrial scale and start ramping up toward their 2030 goal. Thank you very much, and I'm happy to answer any question.
We will turn it over to the questions now.
Okay. Two questions. One, where do you see a strategic fit with Emerson? And two, is around being a pre-seed company, and it looked like 2029, 2030 was when your first revenue window would
The major
open.
ones, yeah.
How do you plan on a model that requires the building of facilities to, make it over the next 7 years?
Right. I answer the second question first. So we are the pre-seed, so that's why we need those non-dilutive investment to do our de-risking experiment. And just because of our business model where we can sell the hyaluronic acid with a much higher price, and we have 60% gross profit, we have that aggressive plan for becoming cash positive in the next 5 years. And just because of we can sell that, every year we can generate $40 million at least by just selling that, right? In terms of the fit with Emerson, I guess we are not an energy company, but we can relate to the energy by through reducing the CO2 and reducing the CO2 emissions. But we can also say that we are also revolutionizing the biomanufacturing because this technology it doesn't need to just focus on sugar polymers. We can produce any other type of materials and metabolites through that process. So we can say that we can revolutionize biomanufacturing. So that could benefit Emerson in terms of coming up with new material for, let's say, a more sustainable biofuels, for example, right? Or other material that could be used for energy purposes.
Where does this fit into the waste disposal supply chain? And so what I have in mind here is, I guess the main thing I have in mind is what's the big risk? Is the big risk that they've just grossly overestimated how the logistics of going around and gathering up wasted food. But is there an obvious place that this fits into, the garbage truck or how restaurants dispose of food and so on that isn't going to require this company to go and develop their own logistical network to collect wasted food?
Yeah, that's a great question, and that's what we are debating in terms of our business model, and that's what we have those two different phases of go-to-market. So I guess as a small startup, it's easier to go to a point source where we can collect a large amount of waste with the similar qualities at the same time. So we are thinking, for example, breweries. If we can partner with breweries and you can have a lot of food waste with the same quality, and you don't need to go to municipalities or the restaurants, right? Also, restaurants, they have their food waste is very heterogeneous, but for example, the farms or breweries, they have very homogeneous food waste. So that's what we have, that go-to-market of first going to the places that is very concentrated food waste generators.
And just to follow that up, so the big competitive risk here is what? Seems like the value proposition is that the costs are shockingly lower than the existing competition. What's a bad competitive outcome here?
So it's on the microbial engineering. So our biggest bet is on increasing the metabolic yield or production yield of our product. Obviously, the food waste as the raw material, the cost is quite low, so that helps us. But converting it or developing or engineering a microbe that can eat those insect-based media and then convert it to the sugar polymer is the biggest risk. And that's what we are using synthetic biology. If we are, right now we are targeting that we can increase the current yield by twofold. If we can do that, we can have 60% gross margin.
I can go. My question is related, kind of a follow-on question. One of the challenges with food waste, I think as you probably know, is impurities in the supply chain. How do you plan to overcome some of those challenges?
Yeah, so I guess similar to the previous question. So first of all, insects, they can eat a lot of different food waste. And they are really good in terms of like digesting different types of food waste. Obviously, they don't digest inorganic waste. So we are thinking of like every once in a while, we would just go and like collect all those undigested waste and remove it from the box and then empty it and start over. But so that's why we chose insects, because they are quite good in terms of digesting all kinds of food waste. And the other thing is like, that's what I mentioned, like at the beginning, we would go to point source that the waste generators that they have really like, homogeneous food waste. Let's say you have a tomato farm, right? The waste from the tomato farm is only tomato, right? So that's quite good in terms of making sure that there's not much impurities, right?
I'm thinking about de-risking and speed to market. And like, how far along is that tech to figure out how to do this? You have like a vial of the sugar polymers, you have like 100 pounds, something
right.
between. Think about that in the context of, I'm sure you've thought about this kind of stuff, but is there a way you could set up like a very early lemonade stand kind of operations where you get the product out as fast as possible, find out, you mentioned like the brewery, and you just test and learn and kind of pivot. And that always obviously can reshape a whole company. But what do you think?
Right, we have outlined 2 years of R&D from now to go to 2 years from now. And then by the end of 2 years, we will have a pilot scale production. And there are different milestones in terms of scientific. There are different milestones that we need to hit in order to reach that level. So first one is engineering a microbe that can actually grow on insect-based media, so let alone producing anything. So once we engineer them for them to be able to grow on the insect-based media, and then we introduce the sugar polymer production pathway into the microbes. And then once we hit that second milestone, then we start doing the optimization, right, and increasing the yield. And at that point, there would be heavy engineering of the microbe itself in order to making sure that they can produce with these sugar polymers with the maximum yield and minimal growth. So these are like scientific terms. But yeah, so once we are at that level and produce enough of the sugar polymers that we can send it to the customers for their feedback and evaluation. So once we are at that point, we can raise pre-seed and then move to the pilot scale and generate, let's say, 100 kilo product. And at that point, we have to also do clinical safety tests. So these are requirements that cosmetic industry needs for any ingredient that's used for, let's say, skincare products. So we also need to do that. And once we are at that stage and we have that, basically those positive tests, we can move to the industrial scale and then go for $5 million raise.
Just a question. You said that the sugar polymer market is 100 million?
Billion.
Billion?
Billion.
Okay, $1 billion market.
Right.
Can you just educate me on that market a little bit, what the growth drivers are and how and why it would be attractive for Emerson to enter that market?
So the largest part of the sugar polymer is the cellulose, right? So cellulose is used for pulp and paper. There are also a lot of alternatives for cellulose right now. So I guess I'm thinking about how like sugar polymers can be used in energy industry. There is a huge segment of sugar polymers that can be used for water treatment. So that could also be used for, so these sugar polymers are the building blocks of the filtration devices for water treatment. So there's a huge application there. a lot of huge application for oil and gas and fracking. So these are the polymers that can be used for fracking. They use millions of pounds every year for their fracking purposes. Processed food obviously is quite quite large application. What other application for energy? Yeah, so these are polymers. These are super large polymers that every time that you want to use any gelling or filling property to your material, they need to use these polymers.
So the food waste space has a lot of startups right now. Most of them are around composting. So
Yep.
you started touching on how, are you accepting more product than composting company? Sounds like not, because you prefer homogeneous waste. So what's the differentiation here?
The differentiating factor is our product. So most of these composting facilities, they produce low-value products like fertilizers or animal feed, in the best case, like proteins. We are producing a much, much higher value products, right? And that's what we differentiate from the rest of the industry.
And do you see yourself paying for the food waste you're going to get in the future? Because there's lots of, right now, people are paying to compost, but since you're making such a high value product at the end, do you have a plan where you remunerate people?
That's a great question. So right now in our techno-economic analysis, we assume that we are paying, I think about $15 per ton. But I think right now the average cost of food disposal is about $75 per ton. So basically, if we want to get to that point, at that point we are minus $50 per ton for our calculation. But right now we assume that we are paying $10 per ton. By 2030, we only need to process 2% of the U.S. Food waste. So I don't think that price projection would change for us. But obviously, once we grow and we take a larger share of the food waste, we may need to adjust our cost estimation.
Okay, we have time for one more question. All right, if there are any more questions, thank you, Amin, for talking to us about Polyos Bio, and we'll set up for the last finalist for today.
Thank you very much.
So anyone who's had their phone or laptop battery die in the middle of the day will agree that battery technology has a lot of room for improvement. Hello everyone, I'm Ankit Vimal. I'm a first-year MBA student at Tepper School of Business.
And I'm Alex Sanchez. I am a chemical engineering master's student.
And we are here to present Power 3D. So the main problem that we are trying to tackle is that battery technology today is not equipped to match the needs of future use cases. I think most of us will agree that we would like it a lot more if we did not have to charge our phone every single day. Technology is growing, and battery technology itself has a lot of catching up to do if it does not want to be the bottleneck. So these are the 4 main pain points that we have identified. First of all, when it comes to the shape and size of batteries, we know that batteries come in set standard shapes. For a lot of use cases, this can be a problem, a limiting thing. Then let's talk about charge capability. If you're just talking about charging speeds, let's say in terms of phones and laptops, it's important. We've seen some innovation and we feel that, okay, we've already come a little way from where we were. But if you're talking about applications such as electric vehicles, we have a long, long way to go before we reach where we should be. Then we're talking about cycle life. Batteries have the cycle life and they're expected to last at least 400 cycles before there is any loss in performance. So even with a lot of innovation that's coming up, that seems very promising, this is something that they're not able to meet. And lastly, there's energy density. So with lithium-ion batteries as well, a lot is being done to improve the energy density associated with them, but this is plateauing. And until we do something that is radically different, it's going to be very difficult to have drastic improvements.
Power3D is a company that is changing how we manufacture batteries in order to get that improvement that we need. The company uses a IP-protected 3D printing process to print battery electrodes. These electrodes can help us create unique structures and designs for batteries that address that space concern that we see with a lot of phone and laptop type products. The printing process also enables ultra-thick electrodes, which have, until now, have been a challenge to make without loss of performance. These types of electrodes are really beneficial for reducing the amount of non-active components, like your current collectors and separators, that really bulk up batteries and take away from the energy density. The technology also allows for better charge rate capability. You can charge faster with the structures that can be printed, as well as cycle life. So these batteries will last longer because of the electrode structures. The technology is based on a scalable aerosol jet 3D printing process. So this takes your slurry materials of electrodes, aerosolizes it, and deposits it on a substrate, which is flexible in terms of where it's being deposited. And this process allows for a high degree of control in the electrode structures, which really enable those key value propositions, such as the energy density and charge rate improvements. Preliminary technical analysis shows that there is a significant improvement in both specific capacity and energy density. The specific capacity has had an improvement of 200% compared to conventional batteries, and energy density has shown a 150% improvement compared to conventional batteries. There's also been a significant improvement in charge rate capability. So Power3D is currently seeking to commercialize these batteries as a battery cell supplier, which means they design and produce electrodes to their customer specifications. But where we think this company could be a good fit for Emerson is as a fabless manufacturer. So that would be taking the IP, the collection of information and knowledge that the company develops, and selling that as a package to battery producers. This fits well in with Emerson's model of automation and process control, where there's a high degree of control in the battery manufacturing process and is rapidly growing and has a need for improvement. In terms of the markets that this best applies for, really this technology is best suited for the wearable and consumer electronics battery markets because of, we'll get a little bit into it, but how the technology fits with the market. So in terms of what that market looks like, the consumer and wearable electronics market is growing rapidly. There's new phone models coming out every year. Wearable technology is a hot topic, and the market is growing at an annual growth rate of 13.6%. The graph here shows the projections for the market size over the next couple years. By 2026, we're looking at a well over $20 billion market, which is a significant market to be able to tap into. Now, the technology is well suited to address this market because it allows for better storage, faster charge capability, and smaller batteries. Analysis of the technology shows that even if these batteries are at a premium, customers are willing to pay that premium in some use cases. The key example here is the Apple Watch, where they introduced a metal can battery that costs 4 times more than the battery they had been using in previous models. But because this new smaller battery had the same power performance as the previous models, they were willing to pay that premium to get the smaller size with more power. Our preliminary cost estimate analysis using a process-based cost model shows that the costs for these batteries will be between $20 and $35 for the battery about the size of an earbud. So it is significant, but really that cost is driven by the printing technology. So if we can speed up that the print speeds we can see that be reduced to $8 per battery. Another key thing to point out is that in a customer market analysis, we found that there's a willingness to pay $10 for an extra hour of charge for a device. So say your earbuds have an extra hour device, the customers are willing to pay $10 more for that technology.
So here's how we look at the competitors. On the first category, we think of those who are investing in solid-state batteries. So this is relatively new compared to all the other technologies that we have out there, and it is unproven at scale at this point. Then we have established battery manufacturers out there who are trying to improve the batteries that they have, the standard lithium-ion batteries that they have, through improvements in process and improvement in material. And then the third one is the next generation lithium-ion batteries. So they're using new materials that are coming up, like silicon anodes. So when we think about these competitions, we are sure that we can match their performance and even exceed them. The other thing is that our process is something that's very adaptable. It's 3D printing, so it can be optimized. And when it comes to new materials like silicon anodes, Power 3D is just as capable of providing that as any other firm. So if we had to talk about sustainability and environmental impact, I would say that, first of all, in terms of sustainability, if we have a battery that lasts a lot longer, it means that you do not discard the device sooner. And again, this leads to less e-waste out there and just better retention for those devices. So it's even eco-friendly for the consumers. And then how exactly is this going to integrate with whatever is out there already, right? So this is based on 3D printing. It can be very easily integrated into the existing production lines that are there. We can optimize it as per whatever needs there are. And if we had to talk about how this is beneficial for Emerson. So Emerson is also looking into battery optimization, and it has taken the software approach to it. So basically, it has this Emerson battery energy management system that it has been working on. And along with the Power 3D, it can have a two-pronged approach to solving this problem.
So looking at a specific example of the impact this technology can have, we can take a look at cell phones. So with the technology, we've seen a 70% decrease in degradation rate for the battery capacity. So this translates to 700 cycles up from a typical cell phone battery, which may be 300 to 500 cycles. And that really translates to 1 to 2 extra years of use. If you look at the amount of batteries that are thrown away in just the US every year, it's something like 160 million per year. So having that extra year or two of use can save 46 million cell phone batteries from the landfill. If you look at what that means from a material standpoint, that can be 240,000 kilograms of cobalt. And I highlight cobalt because that's a very significant material and difficult to find. There's challenges with it being sourced ethically. And so having a significant impact on cobalt's, the amount of cobalt used and imported into the US every year can be a really attractive opportunity. The team for Power 3D is a mix of technical and business expertise. Peter Scott is the CEO who has worked on startups in the past. In past startups, he's raised $10 million for various opportunities and has a strong background in team development and business growth. Alex Sanchez is a technical experience, has a balance of technical experience and innovation and process development experience. And then the core technology is based on the research from Dr. Panat and Dr. Park, who Dr. Panat has worked in 3D printing and additive manufacturing for many years and has really grown his expertise there. And Dr. Park is the electrochemistry battery expert. And then they've also brought on Zahir Imam, who is a MBA that has business development experience in battery startups and has helped commercialize new battery technology. So so the outlook for the company, it is early stage. They have a proof of concept coin cell and are finishing customer discovery through the NSF I-Core program, where they will use that information to inform their prototype development. So a key activity in the battery market is to send prototypes to customers who typically have robust and deep battery teams. So like your Apples, Googles, they have their own battery development teams, and they'll typically work with suppliers to do validation of the technology. So a key activity to getting into the market is having prototypes and technology that these teams can test. And so the next stage will be getting those prototypes in their hands with the key battery materials that they care about, prove out the longer cycle life testing, and use that process to identify a strategic partnership. Long term, that will translate into becoming a key supplier for a battery manufacturer. And as the technology gets developed, it could even turn into scalability for the EV market, which really cares about scale and cost of the batteries. This can lead to either acquisition by a larger battery company or even a potential IPO. The money that's being raised currently is used for this prototyping process. There's a number of key metrics that they're after in terms of performance metrics as well as scale up and development. The key activity that I mentioned earlier about printing and print speeds, currently it's only been printed at 1 millimeter per second, which is quite low, but the machines can get up to 200 millimeters per second. So there's a lot of room for growth and scale in terms of how quickly these batteries can be printed. But this will be all part of the prototyping and development process, tech development process.
Right. So what's the 2-year action plan? So currently they're looking into prototype development and finding the right customer market fit. So that is what is supposed to happen this summer. And in summer of 2024, they want to begin with the MVP development itself. And then what exactly are they doing now? So they have identified the technology. They're trying to establish the product market fit. They want to do a lot of customer discovery. They want to validate their findings. They want to go out. They want to gather insights. And at this point, they are looking for funding to perform prototyping and probably even an interested partner who can help them on this journey.
So thank you for your time, and we're happy to answer any questions.
So is the technology the design, the strategic advantage here? Is it the design of the lattice work or the structure of the 3D printing in combination with the materials being used? How is that IP protectable? Can you talk about the secret sauce here?
Yeah, you're right exactly with the kind of the value proposition where it's coming from. The machine, the 3D printing technology itself is out there in industry, used in a lot of like semiconductor, PCB type manufacturing. Where the IP comes in is protecting the use case of the materials and the structures, and it covers a pretty wide use case in terms of what we're able to print, what they're able to print, and so that enables this next generation of battery manufacturing and technology that can't be necessarily replicated by competitors. And I did want to highlight competitors. There's only probably 2 or 3 competitors that are seriously looking at 3D printing for batteries, and they're typically using different processes. This is closer to like inkjet printing, and so if you think of newspaper speeds, it can get really fast versus typical like metal layer deposition type 3D printing, which is where competitors have been focused so far. And so we believe there's a strong advantage here with the speed that this can match compared to other 3D printing processes.
And you say the initial focus is on consumer electronics, but you referenced it might be at some point at scale applicable to Tesla. How does the printable technology scale in that way?
Yeah, so the key activity there is going to be working with the developers of the printing technology, because current technology, I believe on the market there's only a 4 print head printer. If we wanted to scale that up, we could work with that organization to scale up the number of print heads, which is really where the speed advantage would come in. So if you have a large conveyor belt with this 3D printing technology, you could have 20 to 100 print heads on a large technology. That system just isn't there today. So that's really where that's how the technology would move into like an electric vehicle space, is if you could scale up the printing technology with multiple heads.
And finally, for me, it looked like you're about 15 months out from first prototype. When are you forecasting first positive revenue?
Yeah, so it's been a little early for us to determine that because we're still finalizing customer validation. The positive news is that the companies that do this prototype testing will pay for prototypes. So there's a small revenue that would be coming in from just sending prototypes to the customers for testing. But that would, I think we're looking at, relatively small, 50 to 100 K for prototypes over the next, starting next year. And then the goal is to develop a pilot line after that, where we could start getting revenue by, what year does that put us in? 2025-ish. But the numbers are difficult to determine at this point.
I'd like a little clarity on who the competition is. When you discussed the competition, I got confused about customers versus competitors.
Sure.
I think you know what I mean. So could you just clarify where the big competitive risks are?
Yeah, so the big competitive risks are with new materials, and solid state is one that's growing and gaining a lot of interest, solid state batteries. So it's a new type of chemistry. It's very unproven, and the scale has proven to be very difficult for these companies, but the performance advantage is why they're garnering such interest. So you have like QuantumScape is a big one, Solid Power, and then some of these other EV company or vehicle companies are investing in that technology as well. And so that's why they might look like customers, but they also have their own groups that are doing this development. But really where the distinction between the competition and that we believe that Power 3D has is that the process is material agnostic, and so it can ultimately be used for solid state materials as well as some of these next generation materials like silicone, and so that's where the competitive advantage for Power 3D is. Really the biggest challenge for Power 3D will be the scale and making sure that the printing gets to where it needs to be for the batteries. So, did I answer your question?
Yes.
In follow-up to one of Thurston's questions, I'm trying to figure out the fit within Emerson Ventures. So you said the target customers are wearables and consumer electronics. Where is the commonality with Emerson's customers, or how that would fit in with Emerson? And then 2, you've said that Emerson takes a software approach. So what exactly is the approach you're suggesting through Power 3D?
Yeah, so the potential synergy would be with a fabless manufacturing approach so Emerson is on the production side in some battery manufacturer locations, and so they help with the mixing and the process, the assembly of these batteries. And so having the technology to protect the manufacturing process, as well as those external components like the controls, the battery management systems, which is on the software side, the Emerson, forgot the name of it. Essentially the control systems that go behind the manufacturing process. Those can be combined with this specific process and packaged together as a battery manufacturing offering that could be used for manufacturers.
Right. Also, I think at this moment they're beginning with wearables and smaller batteries, but eventually the plan is to move into bigger segments. And that is where the true fit will come into picture, because Emerson is already present there and doing some work. So it's more long term at this point, this fit that we're talking about, but that's where the software approach that we'll be talking about. So basically, the battery energy management system that they have. So they're trying to control the charge and discharge cycles, so as to get to that optimal number. So that's where we say that, okay, the software itself is doing this, but unless you have really good hardware and great material, it can.
So you're saying Emerson has the software, this would provide the hardware?
Right.
Okay.
That's true.
So there are obviously a ton of companies trying to figure out batteries right now, like tons of money, a lot of smart people. Why do you think they have not explored 3D printing as an approach, or have they and I just don't know anything about it?
Yeah, I think it goes back to the scale question, especially with like electric vehicles. They're trying to figure out how to make their batteries as quickly and cheaply as possible. The thing is, no one's really looked at this type of printing for battery applications. Like I briefly mentioned, but a lot of it has been in metal layer deposition, which is you kind of go layer by layer as you build up the electrode. So it's a more solid, kind of more similar to what conventional batteries look like if you look at like the internals. But with this, we're creating new structures that really enable the performance benefit that the industry is after. And so it's a different approach. It's using manufacturing to get the performance benefit that we're seeing rather than this materials approach that has been mainly pursued. And then those that are looking at 3D printing are doing both rather than one together, if that makes sense.
In terms of climate impact, you talked about the cobalt and the cell phone saved, but I don't think you mentioned the carbons. And even though not everybody understands tons of carbon, that's a metric you should share. And do you know it on top of your head or no?
No, I haven't been able to do that because we haven't scaled up the process to the point where, essentially, yeah, we're still a little bit ways away from figuring that out. But it's definitely something we have on our mind to figure out.
Yeah, amazing presentations. Let's please give them a round of applause.